Happy Monday, everybody. Houston, we have a problem. Not just Houston, but California, Florida, and many other states that are impacted by horrible climate events. In fact, homeowners are spending a growing share of their mortgage payments on property insurance, which is now rising faster than principal, interest, and taxes, according to September ICE Mortgage Monitor. Joining us now to talk about this growing problem is David Snyder. He's the vice president of the American Property Casualty Insurance Association. I think you're joining me from not too far from where I am here in McLean, Virginia. Am I right?
Yep. Thanks a lot, Gregory. Falls Church.
Falls Church. All right. So just a town or two over. I first saw you speak. Was so impressed with you. Rick Sharga has this roundtable a couple of times a year. He's a very highly respected mortgage executive, and you spoke about this problem, and that was about 6 months ago. And I've addressed this problem too. I've called rising homeowners insurance the biggest ticking time bomb in mortgage because delinquencies are going up, foreclosures are going up, payments are going up for people that are already so stretched in the first place. How big of a problem is this? And give us some trend data on whether it's getting better or worse.
Well, let me first say thank you for including me today. A couple things to keep in mind, and I really want to stress this issue. Insurance is sort of the bill that is being sent to reflect a series of decisions that are made about risk going far beyond just insurance and much earlier even than the insurance purchase. For example, where a building is built, how it's built, what are the building codes, what are the climate conditions. These are the raw materials, if you will, that go into an insurance bill. And regrettably, those conditions, those preconditions, if you will, keep going up. And that's a concern for us. And I know it's a concern for mortgage lenders. And most importantly, it's a concern for the consumers that mortgage lenders and we both serve. Is it a growing issue? Yes, it is, because risk is a growing issue. And only when we work collectively to address the underlying risk are we going to be able to sort of moderate the current situation. And we recognize that delinquencies are going up, but the causes may be far beyond insurance. I haven't seen any specific insurance-related data, but we realize that insurance is kind of adding on to the pressures that folks feel out there
sure.
in the market. For sure.
Yeah, when you look at the segment of mortgage population that is becoming more delinquent, and apparently your dog has something to say about this crisis too. So we're going to get the dog involved here in a minute. I love dogs, by the way, just so you know. If you need a dog walker, I'm not far. We've already established I'm just a town over. But in all seriousness,
Right.
FHA loans already require a very, very small down payment. Historically, there are gift funds and things. Like, it's a stretch to begin with, and insurance costs are adjusted annually. So if you thought you were getting a loan at 48%, debt to income ratio, and all of a sudden the part of the PITI is going up 10% or so, then you have to make decisions. And some of those decisions are as dire as food on my table or paying my mortgage. So, I think it's pretty evident that this is a problem. The question is, you mentioned a second ago that there are things that can be done to mitigate the problem. Where are we in that process, and what are some of the specific solutions that can bring it, more in line? And a third part of the question: how long is it going to be until there's some relief?
Yeah, and I know it's challenging for everybody, and we respect certainly the challenges that consumers have, the challenges that everyone in the mortgage lending area have as well. There are a couple sort of short-term solutions. People need to shop for insurance. They need to take a look at the deductibles that are available. We're starting to see in some states addressing the underlying causes of and improving building practices. Louisiana and Alabama in particular have a very good experience with a program that takes the science-based insurance standards for fortified buildings as a core. And then the government provides mitigation grants. That's money to help you, repair a roof or, replace a roof or whatever, mitigation grants. And then the insurance industry provides actuarially based rate reductions. So that program seems now to be going national, and we're seeing more and more states enact it. Let me review again the core elements of it. Number one, there are science-based standards for mitigation. Lots of people talk about mitigation, but the insurance companies have to have faith in the mitigation in order to provide the discounts. So the insurance industry provides rate discounts, and the government provides grants for mitigation. That's working extremely well in Alabama, Louisiana. Thousands of people are saving money, and that seems to be a way forward, a sort of cooperation between the government and the insurance industry to address underlying risk. So we're very positive that that's starting to emerge. A second area of positive development is in Florida. The legal system abuse had gotten out of control, and the legislature recently addressed it. And companies are coming back to the market, and that's a good thing because that'll put competitive pressure on others. So that's kind of what we're seeing as positive developments, addressing the risk and the underlying costs that go into an insurance bill. And then that in turn is being reflected in lower insurance costs. The other positive development that's important to do is getting information about insurance costs and risk exposure to people when it counts. And there we see in the real estate industry, there's a growing use of information like that given to the consumer at the time that they're making a purchasing decision. Because if you don't make it then, it's going to create problems for everybody.
Yeah, a question for you. Whenever there's moments like this where premiums are going up, in inflationary environments, right? And this is not necessarily a direct correlation to the economy and inflation bubbling up, but in these moments, there are some bad actors out there that will say, all right, well, they're raising, so I'm going to raise. Look at, it's totally unrelated, but in the mortgage business, FICO raises their prices, so the three credit bureaus decide to raise their prices, and so the CRAs, who we buy it all from, the credit from, they decide to raise their prices. Has there been some bad behavior? In other words, are some of these prices, elevated because some insurance companies are leaning into it and taking advantage of the moment?
Well, I'm glad you asked the question because insurance rates can only be charged if the insurance regulator has approved them company by company. So unlike other industries, if you will, that are purely market-based, in our case, our pricing is regulated by the state insurance departments, and that's a critical point. So that means that in each state, the company has to file its rates. In some cases, in fact, the government has to approve the rates before they're charged in the market. In other cases, the insurance department has the authority with a complaint or otherwise to open up a rate filing and challenge that rate filing after it's being charged in the market and require the company to pull it back and change it. So regardless of the exact form of rate regulation you have in the state, that insurance pricing is highly regulated by state governments, so they
Yeah,
can't
so
try.
in other words, you can't. It's tough to speed. It's tough to be a bad actor in the space. So I
It
mean,
is,
thank you for answering that question. I just want to read some statistics, and I'm getting this from the sturdy hand of Housing Wire. I get a lot of news from them. Love Housing Wire. They shared this report from ICE Mortgage Monitor from just a couple of days ago, September 8th. Slower but steady growth. Property insurance payments rose 4.9% in the first half of 2025, driving an 11.3% increase year over year. Over the past 5 years, insurance has climbed nearly 70% compared to increases of 23% for principal, 27% for interest, and 27% for property taxes. And lastly, the cost per $1,000 of coverage rose by 29 cents or 5% over the past 12 months, and by 85 cents or 16% since 2022. How much of natural disasters and hurricanes and fires and floods do you attribute to to this moment that we're in? What if you had to just pull from the sky a percentage? Is it 50%? Is it 100? Is it 80? What is it?
yeah. It's all I can say is it's a major factor. But
Majority factor though, above 50%.
it's not the only. Yeah, I know. I wish I could do more, and I can't right now. But
So you're not able
um,
to answer. You're not able to answer that question, right?
well, the data would be available from the individual companies. I don't have it right now. But keep in mind that even the typical claim, let's say a fire, um, it's causing an inflationary increase in insurance because the cost of materials as a result of
You're having to replace, right?
tariffs. Right. The
Yeah,
cost of
exactly.
materials has gone up, labor. If you're talking about an automobile insurance claim, the cost of repairing and replacing new cars has gone up significantly. But the increase in homeowners insurance, yeah, in large measure is caused by natural disasters.
Yeah.
But the
David,
other factors for day-to-day claims are also going up.
David, you had mentioned a minute ago that the government has stepped in some way. And I didn't fully understand it because I'm not in your game, right? I don't, but I
Sure.
understand the government is lending in and helping out. I have heard some people suggest that a FEMA style backstop would
Hmm.
be a solution.
Yeah.
Is that is that something that you would support? And any reason to believe that the government might come in as the ultimate backstop to try and drive premiums down?
Yeah. 2 points on that. The first one is that we would be very cautious about an approach like that because what's happened is in states that have so-called fair plans, the fair plans underprice the product. A huge deficit is raised, and then the question is who picks up the deficit? The insurance industry or the taxpayers? And it kind of hides risk because traditionally those fair plans underpriced. So we would expect that a government-run program of the kind you're talking about would also likely underprice the risk, create a huge deficit,
Interesting. Wow.
and yeah,
Never thought about that.
yeah. So it really, unfortunately, that approach has not really worked out well in the past. And then the next question is really a political question whether this Congress and this administration would take on a new federal program like that when they're
Yeah.
cutting when they're cutting most other programs. So,
Yeah. We're not. Let's not go down that road.
yeah,
I am gonna share a slide that you authored. This is your slide,
yeah.
and so tell us what we're looking at here.
Well, what we're looking at is the natural catastrophes that are happening just in the first quarter of 2025, and that's largely California wildfires. But the other, what we call secondary perils, namely severe convective storms, are causing tornadoes are causing a huge amount of damage, and don't get the publicity that the California wildfires do. So this paints a picture of a first quarter which is historically costly. in terms of U.S. natural catastrophe losses. So that gives you some idea of what we're dealing with. If you go to the next slide, it'd be really helpful. I don't know if you can go to the next one. So this tries to summarize what's really causing the homeowners losses, and we've had a good discussion of those. First of all, macroeconomic pressures. First of all, incredibly, people are building more and more in natural catastrophe prone areas, climate sensitive areas. It's where people, I guess, want to live, but the problem is that the losses are rising significantly in those areas. Then the next issue is climate. It's undeniable that the climate is changing. It's creating variability and it's creating extremes. And finally, what we call government risk, which is A, failing to allow the adequate rates. Remember, the states have to approve insurance rates, the failure to allow adequate rates, but also the failure of government to do things like infrastructure work. Like a lot of flooding could be prevented with good storm water systems, and yet government doesn't have the resources to put into those. And government allows building in on the floodplain or near the floodplain. So that's kind of a look at the macroeconomic factors behind costs. If you pull up the next one, we recognize that the insurance industry has a key role to play. First of all, programs like this allow us to work with other sectors to understand the risk that we see growing and to work with those other sectors to see what we can do cooperatively. And that provides a good example of the collaboration that we're doing in working with other sectors such as mortgage lending. And the next one then. So in my view, here are the key points. Affordability is a major issue. We realize that. We don't want it to be, frankly. But affordability is a major issue. And Greg, you've mentioned that very, very clearly. In our view, the key to addressing it is the risk mitigation programs, both individual and collective, for examples being Alabama and Louisiana. And we're also pushing state regulators for more flexibility to tailor coverages so that if you can't afford the Cadillac policy, do you have other policies that allow you to provide at least some coverage? And that's something we're working on with state regulators. Availability problems can be created when the state regulator suppresses rates, and we've seen that in California. And the key to right now for the short term is allowing risk-based rates. And finally, what we think are the real solutions is to, and we have a key role to play, we recognize that, is society-wide and government-wide approaches to addressing the risk that insurance companies are delivering the bill for. So
how long have you been in the insurance game?
Probably 40 years.
You started in the 70s.
Yep. Late 70s.
Got it. It's changed a lot, huh?
It's changed a lot, but some of the realities are still the case, which is risk is created by individual and governmental decisions. You load on top of that inflation and the worst catastrophes we've seen in years, but a trend up in terms of natural catastrophes. And it's created this situation. And we do think there are ways out of it. And we want to get out of, believe me, we want to get out of this situation as much as anybody else does.
Yeah, I'm wondering what best case scenario is and how long it would take to put that in place.
The best case scenario, actually, we're seeing in Alabama and Louisiana with very, very rapid rate decreases. And the better yet, frankly, improvements in the ability of houses to withstand natural catastrophes.
Does it start with just building a stronger house?
Yeah.
Got it.
And
when you see lenders,
where the house is located.
And where the house is located. Well, you made a comment a minute ago. I'm like scratching my head. Like, people are still leaning into communities where there's been natural disaster after natural disaster, or areas where you're not too far from hurricanes, for
Yeah.
instance.
Mhm.
I don't know. That doesn't seem very smart to me. Um, can is it an okay thing to do if the house that was blown away on that same land now is built 10 times better? I mean, is that the idea of getting people back to those areas, or are we going to reach a place, and this is a political question, are we going to reach a place where fires are commonplace in California, and hurricanes are getting worse, and people now, maybe just want to move out of those areas, and you want to just condemn them and get those, no more people living in these areas? Like, could we ever end up in a, I guess the climate folks, would say that, yeah, you should maybe consider starting to move away from these troubled areas. They're not going to get any better. What's your opinion? Can you give your opinion?
I would say that I prefer a slightly different approach, which is people being given good information and hopefully making rational decisions on their own. But I think increasingly you're going to see people making rational decisions to move out of those areas.
I mean, would you move to Louisiana right now? What would it take to get you to move right, right, just sitting right up against the Gulf? Was there
Nope,
any amount of, is there any amount of money that would have you move
not
down there?
not not in my case. Not in my
Yeah.
case. But if you're living there, then there are programs actually to help you have a house that's more likely to withstand
Yeah.
the storms.
So the most important question I have for you is this: are the haves covering the cost for the have-nots? In other words, are these disasters that are making premiums so much higher in those areas being supplemented and paid for by people like you and me, who live in areas where
Well,
this isn't a
right,
problem?
right. To some extent, there is risk sharing across, but the rates that are filed in any given state have to by mostly, and again, this is actuarial, it gets very, very complicated, but the rates that are filed in a particular state have to reflect primarily the losses in those states.
Got it. Does this get better or worse from here?
My hope is that it gets better.
I know. I don't want to talk to your heart. I want to talk
Yeah,
to your head for a minute. Does it get
yeah.
better or does it get worse?
It depends on whether we're really willing to make tough decisions, and that goes all the way to the local level. Are we willing to support infrastructure projects like stormwater systems? Um, are we
But Dave, that takes a long time. That's not a light switch, right? So I mean, it's
right?
going to get. So the answer is it's going to get worse, but how much worse depends on what happens at the ground level and local, state, and government levels, right? I mean, isn't that what
Yeah,
you're sort of saying? Yeah.
or it doesn't improve.
All right, real quickly. So, in your capacity as vice president of the American Property Casualty Insurance Association, what does the association do?
Work with folks like you and other industries, with the government to try to encourage folks and with the general public to encourage folks to understand for what their risk is and how they can improve that risk going forward.
How big's the association? How many members do you have?
We have 1,200 individual insurance companies that are often organized into groups, but 1,200 individual insurance companies.
Interesting. My last question. Well, I have two more questions. When you see these mortgage companies that are consolidating and selling this idea of a flywheel where you go get the mortgage and you go get the staging and you go get the title work and you go get the insurance, and they offer all of that under the same umbrella, any thoughts on that, on that practice at all?
No, I can't really comment on how other sectors do business.
All
I
right, no
prefer,
problem. Can we talk? All right, let's just talk about your dog then. I don't know. I've never seen your dog. This is the first time we've ever
my
spoken
dog
like this.
doesn't talk about that either.
I know your dog doesn't talk about that either. But I'd like to try and guess the kind of dog that you have based on the bark. This could be like a new podcast series, by the way. I've never seen your dog, right? Can we confirm that I have no idea. We never
Yeah,
talked about your dog. In
that's right.
fact, this is the first time we've ever talked. I saw you speak so eloquently as you have today, at that roundtable, and then I invited you to be on this call. I am going to guess. I mean, what do you think I can guess? What kind of dog do you have? I mean, do you think that if I had three guesses, that I'll be able to hit it? It's a big
Yeah.
dog. That's not a small dog. That wasn't a poodle.
No,
That's not
that's
a that's not a Yorkie.
mhm.
Um, I'm going to guess. I mean, that sounded to me a lot like a German Shepherd.
Yep, a mix with German Shepherd and nice work, nice work.
Yes. Does that mean you'll come back as a guest after the next natural disaster? God forbid.
If you'll have me and invite my dog as well.
Of course, you're both welcome to any time. Dave Snyder, I really appreciate your time. Thank you so much for joining us here on One on One.
Thanks a lot, Gregory. Appreciate it.
Yeah, it's no problem. I'll even let you call me Gregory. That's how much I enjoy this. You and my mom now. It's down to two. Have a great Monday, everyone. We'll see you next week.